Next up, let's focus on moving average crossovers. So generally, a rising moving average indicates an uptrend, and a falling moving average moving down, indicates a downtrend. Now, this information is useful, but it's not necessarily actionable. How do we act upon that? And typically, this information by itself requires other viewpoints, other factors to confirm, other means of analysis. Now, one way that we can use that information is to look for moving average crossovers. And that's one way that moving averages are useful and are generally utilized for trading. By using two different moving averages in a chart, traders may see a short-term moving average crossover above or below a long-term moving average. Now, here are some examples of this. This is Bitcoin to US dollar. This is a daily chart. And here we're looking at the moving averages, the 9 period in the pink, this pink line, and the yellow line will be the 50 period. Now, in this situation on TradingView, I have utilized the moving average cross indicator. So with this, I actually input which two moving averages I want to use, and it actually marks exactly where they cross over. And I use this for this example. I personally don't use the crossover indicator on my own charts. I just use two different moving averages, and I look for the crossovers on their own. But I feel for example purposes, it's nice to just have that cross there. That way it's really clear and obvious where it crossed over. So here is a moving average crossover indicating a possible shift in the trend, right? So here, each one of these crosses, this is from 2020 into 2021, late 2021, we see a moving average crossover where this shorter term moving average, the pink line, will either move above, representing an uptrend or a shift in the trend, or possible shift, right? Here we see the pink line was below. It's crossing over in October 2020, signaling that there's some sort of uptrend. Recent prices are moving up higher, and the recent moving average is moving upwards and higher than the long-term moving average. Now, this is countered by the short-term moving average moving below and crossing below the long-term, indicating a downtrend. So this indicated a downtrend. This was in September of 2020, which particularly for that month, there was a period of downward movement in the market. And this was rightfully so. The price was rejected multiple times below the longer-term moving average of 50 MA. So this was a valid position to take and a valid consideration to take, I should say. Now, moving forward, what's interesting here is another thing to note is when you're using these multiple moving averages, we also want to keep in mind the amount of space between the two. Moving averages spreading apart indicate a potentially strong or strengthening trend, where if the short-term moving average, in this case the 9 in pink, is spreading apart, is above, and there's a widening gap between them, that's an indication that the trend is strong, that we're in a strong uptrend. Likewise, the flip side of this is when the shorter-term moving average falls below the long-term one and we see a widening gap. This is an indication where the downtrend is a strong downtrend, which we did observe in May, June, July of 2020. Here we see multiple instances of moving average crossovers indicating a potential shift in the trend. And what's important to note here is that it's not always an immediate thing. It's not always, oh, there's a crossover, that means we're going to crash, right? We saw this in late April where there was a moving average crossover to the downside and between the 9 and the 50 MA. Price actually came back up, moving average actually crossed back up, but then failed to produce a higher high and actually crossed back down. So there was actually 3 instances of moving average crossovers here. So this is something to keep in mind, that it's not actionable solely on its own. We want to look at for other forms of analysis. In this case, just understanding basic market structure would have told us, hey, we've formed a lower high. We need to form a higher high at this point. The failure to do so indicates that it's a weakening trend and that we're probably going to see a trend reversal, right? Buying power is weakening, bear pressure is increasing, selling pressure is increasing, because if buying pressure was increasing, we would have already formed a higher high here. This is just more of a confirmation, like, hey, the weakening of the trend, even just the fact that we went from October up until late April, where the short-term moving average was above and really maintained this large gap, a rather large gap, really just tightening around here around February and a couple other instances. But for the most part, we saw this large gap between the moving averages. The fact that it actually crossed to the downside here was a strong indication that, hey, this trend is weakening. Now, one of the crosses is the golden cross. A golden cross, or a bullish crossover, it really depends on what you want to call it, occurs when the short-term moving average crosses above the long-term moving average. For example, imagine a 50-day moving average raising and crossing over a 200-day or 200-period moving average. Now, there's three parts to the golden cross and to these crossovers. The short-term moving average is below the long-term moving average. So this is what we see before the trend reversal. This is seen during the downtrend, right? Because the golden cross indicates an uptrend or reversal to the upside. So we're first starting off moving down. The second part is when the short-term moving average raises and crosses above the long-term MA. This is accompanied with an overall trend reversal. Prices are starting to reverse to the upside. And then the third is the reversal results in an uptrend. So there are three main parts to a golden cross. First part is the short-term moving average is below the long-term moving average. So we're starting off in a downtrend. Prices are going downwards. At some point, prices are starting to recover. Maybe we're starting to see a shift in the market structure. And as a result, from that shift in prices are starting to go up. The short-term moving average will raise and cross above the long-term moving average. Now, this is accompanied with an overall trend reversal to the upside. Finally, the reversal results in an uptrend, a clearly defined uptrend, where the short-term moving average stays above the long-term moving average. Here's an example of this in play on Bitcoin. This is the moving average cross between the 50 and the 200-day moving average, the 50 in pink and the 200 in yellow. We're particularly focusing here. Prices were in this downtrend. Prices are starting to come up. The 50 MA, or the short-term move MA, is reacting to price going up, and here we see our crossover in mid to late September. Prices are coming upwards, 50 MA is coming up, and we are confirming a downtrend. What's interesting is that even though we had this golden cross, price actually dumped towards late September, right? Price actually dumped right after. So it's not always a clear indication of, hey, this is the uptrend, we had a crossover, that's it, I'm going to long. We want to look for multiple factors. Now, if you longed off of this, let's say that was around 45K, price actually went up to about 50K. So technically that would have been right, but in terms of the broader market and the broader market structure of the asset of Bitcoin at this particular moment, this was not the move. We want to look for other confirmation, right? What we did see was overall we saw a low, right? A reversal from this downtrend, high, a low, a higher high, a higher low, higher high, higher low, higher high. market came down. So this was a moment of confusion, right? Because technically we formed a lower low compared to here and here, right? Now if we're looking at the broader market structure, technically we could make the argument that this was a higher low than maybe this one or this one, but still arguably it was a moment of contention in the market. So we really want to look for other indications. If you were looking for a short-term trade right off this crossover, maybe that would have worked out. But in terms of a broader trend reversal, this was not the key. This was not the sign, because we did ultimately come down for a significant dump down to wicking even below 40K for a few days, maybe about a week or so. Now, the reverse of a golden cross is the death cross. So death crosses, or bearish crossovers, are the opposite of a golden cross, where the short-term moving average falls below the long-term moving average. This is an indication that recent price averages are falling in comparison to the historical or long-term average prices, and can be a signal of a downtrend. The three phases of a death cross are the uptrend, right at the beginning, we're moving upwards. Short-term moving average is above the long-term moving average. The trend reversal, where the short-term moving average falls below the long-term moving average, is where we actually see that crossover. And then the resulting downtrend, where the short-term moving average stays below the long-term, or even further distances itself from it. We start to see that gap increasing, signaling that the trend is strong or strengthening. So here's an example, is Bitcoin to the dollar. Same example as we saw before. In this case, particularly the cross that we saw before, the golden cross here, this is our death cross, where we have our 50-day MA in pink, the 200-day MA in yellow. Prices were extremely wide here. We saw that this was a very strong uptrend. Price dumps, we see this May crash all the way down to about 30K, and really failed to recover for several months at this point, several weeks to months at this point. Moving averages, once again, they are lagging indicators. They take time to reflect what's actually happening, because they're factoring, especially these larger moving averages, because they're factoring in 50 days worth of data. So as days go on, price really fails to recover to highs and really continues to plummet, right? We're starting to see this slow deterioration of lower highs, lower lows. Eventually, at some point mid-June, we saw a death cross. So this was a sign of a bear market. There was a lot of contention on social media, people saying, "Oh, the death cross has appeared, bear market's over." And really failing to realize and factor in other indications, where I was like, all right, where is a long-term bottom? Well, clearly 30K, as observed in January and into February, was a very strong level of support. And here we saw it did play out as well, going into May and June and into July as well. So the death cross is a cause for concern, but once again, it's not something I would have acted on its own. Now, let's say if you opened up a short right here on the death cross, as soon as it appeared, you open up a short. Technically, that would have worked out, right? I mean, if we take a look at this, because price was here when the death cross appeared, when the moving average crossed over, let's say about 38K. Price actually fell down to, let's say, maybe about 29. So in theory, that would have been a successful short on the immediate appearance of the death cross. But that's not something I would only act on its own. Just because the death cross showed up does not mean I would have shorted, right? I would look for other indications. I mean, if we take a look here, even without really having an in-depth analysis, here we see that this was a significant level, this level about 42K, right? Price came up to 42K, and if it's coming up to it from the underside, it's typically going to act as resistance, right? And we saw that price came down to here. It tried to hold for a little bit and ultimately fell down. Price came up to 42K, was rejected. And for many times since then was continuously rejected, forming lower highs. Price came up to 42K one more time. We have reasonable expectation to expect that it was going to be rejected, right? The trend is your friend. Trade with the trend. We are in a downtrend. You have good reasoning to believe that resistance will not be broken unless proven otherwise, right? And the same thing in reverse for in an uptrend. If we're in an uptrend, you have good reason to believe that the support is going to hold unless proven otherwise. So here we saw price come up to a previous high, failed to produce a higher high than the one above here, and ultimately was rejected. At the same time that the death cross appeared, the short was valid at that point. But shorting just on the death cross alone, not a great idea. We want to have other means of analysis, other means to prove and make our statement, make our claim to what is going to happen. Finally, let's talk about some drawbacks of moving averages. So moving averages are fairly simplistic. It's important to remember that moving averages are based on historical prices, so it's considered a lagging indicator. It's based on things that have already happened, and depending on how large of a time frame or how large of a sample set you set those moving averages to, they will be lagging. They will take time to reflect on what's actually happening right now. So that's something to keep in mind, that they're based on old price data, and it's not always going to reflect what's actually happening and what could happen in this very moment. Now, lagging indicators trail behind the price action of the asset, meaning that they can only show price changes that have already happened. They can be used to confirm trends, but may not be as reliable when used to make predictions on future price movement. Now, for example, if someone relies too heavily on moving averages to enter trades, the best entry position may have already passed and the trader may be entering the position too late. That really depends, right? We don't want to wait just for moving average crossovers. We don't want to wait for, price came down to the moving average, I'm going to long, right? The moving average is going to act as support. Maybe there might have been a better position for you to do so, or maybe waiting for a better entry position. So that's not something that I would rely on solely just for entries or exits. We also want to consider the size of the data set. So the bigger the data set, the larger the time period, the more the averages will lag behind the current state of the asset's price. So for example, a 100-day moving average indicator will respond much more slowly to new market information compared to a 10-day moving average. So if you have that 100-day moving average set, you're not really going to see that much of a reflection on what's actually happening today or yesterday or tomorrow compared to those smaller moving average sizes.